Bond investments, stability and income generation. Unlike stocks, bonds offer lower returns but are considered more reliable. A bond represents a debt security that reflects the relationship between the issuer and the investor. When additional funds are needed, the issuer issues bonds. By purchasing a bond, the investor effectively lends money to the issuer, who commits to repay the debt at a specific time with interest. Reasons to consider investing in bonds. 1. Limited involvement in company management. Bondholders are not obligated to participate in the management of the company issuing the bonds. They are primarily interested in receiving the agreed-upon interest payments and the return of their principal investment. 2. Guaranteed interest payments. Interest payments on bonds are guaranteed. The issuer establishes the amount and frequency of these payments when issuing the bond. This distinguishes bonds significantly from stocks, as companies are not obliged to pay dividends to shareholders. 3. Specified term. Bonds have a specified maturity date. Typically, the maturity period ranges from 1 year to 5 years. This allows investors to plan their investment horizon and manage their cash flow accordingly. 4. Higher chance of repayment during issuer liquidation. In the event of the issuer's liquidation, bondholders have a higher likelihood of recovering their investment compared to shareholders. This is because bondholders have a higher priority in the repayment hierarchy. However, bond returns are relatively lower compared to stocks, and there is no protection against default risk. To minimize risks, it is recommended to invest in bonds with high credit ratings. Bond investments can offer stability, predictable income, and a defined timeline for investment returns. They are particularly suitable for investors seeking a more conservative and reliable approach to growing their wealth. It is essential to conduct thorough research, evaluate credit ratings, and analyze the financial health of the issuer before investing in bonds. Remember, diversification across different types of bonds, sectors, and issuers can help mitigate risks and optimize your bond investment portfolio. Emerging trends in bond investments. In recent years, the bond market has experienced notable trends and shifts, presenting new opportunities for investors. Understanding these emerging trends can help investors make informed decisions and adapt their bond investment strategies accordingly. 1. Rise of ESG bonds. Environmental, social, and governance (ESG) bonds have gained significant popularity. These bonds focus on financing projects that promote sustainability and social responsibility. Investors increasingly prioritize ESG factors, seeking both financial returns and positive societal impact. ESG bonds offer an avenue for aligning investments with personal values while diversifying portfolios. 2. Growth of green bonds. Green bonds specifically target funding for environmentally friendly projects. As the world focuses on combating climate change and transitioning to a greener economy, green bonds have become an attractive investment option. These bonds finance initiatives such as renewable energy projects, energy-efficient buildings, and sustainable transportation. The green bond market continues to expand, offering investors opportunities to contribute to a more sustainable future. 3. Increased demand for corporate bonds. Corporate bonds have witnessed growing demand as investors seek higher yields compared to government bonds. Companies, particularly in emerging markets, are issuing bonds to raise capital for expansion, acquisitions, and refinancing. With thorough research and analysis, investors can identify well-established companies with strong credit ratings and potential for steady income. 4. Impact of central bank policies. Central bank policies, such as quantitative easing and interest rate adjustments, significantly influence the bond market. Investors closely monitor these policies as they can affect bond prices and yields. Understanding the actions and intentions of central banks can help investors anticipate market movements and adjust their bond portfolios accordingly. 5. Rise of emerging market bonds. Emerging market bonds have gained attention as investors seek higher returns in a low-yield environment. These bonds offer the potential for attractive yields, but they also come with higher risk due to factors like currency fluctuations and political instability. Careful analysis of emerging market economies and their fiscal health is crucial when investing in these bonds. 6. Growth of sustainable and social bonds. Sustainable and social bonds have emerged as another avenue for impact-driven investing. These bonds finance projects with a focus on social welfare, such as affordable housing, healthcare, and education. They provide investors with an opportunity to support initiatives that address pressing societal challenges while generating financial returns. As the bond market continues to evolve, staying informed about these trends can guide investors in building diversified portfolios and capturing potential opportunities. It is essential to assess risk tolerance, conduct thorough research, and seek professional advice to make informed decisions aligned with individual investment goals. Remember, bond investments carry risks, including the possibility of default and fluctuations in interest rates. Therefore, investors should carefully assess their risk tolerance and consider diversification and long-term investment strategies to optimize returns while managing potential risks.